Welcome everyone to Vested Interest. This is Shane and back again for a portfolio update. We do these every Sunday morning, but before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. I really do appreciate it. Coming up on 1,000 subscribers, and the channel continues to grow because of people like you. So again, thank you so much. But for those of you who may be stopping by for the first time on this channel, we focus on dividend growth investing. It's not rocket science, in my opinion. The best way to do it is keep it as simple as possible. So it really boils down to consistently investing, dollar cost average. I invest weekly. Uh, when I get paid, I also do larger chunks whenever I get a bonus or side job or something like that. But I consistently invest in the portfolio again on a weekly basis. Um, I cover all my investments into the portfolio on this channel. I do not have a paid Patreon, nor do I tend to have one. We all have enough to pay for. I don't have any other paid sites to send you to. I'm not trying to sell you any courses. There's nothing to buy here. I may have some merchandise in the future, but that'll be up to people whether or not they want it. Maybe some T-shirts or something like that. But as far as seeing what I'm doing in my portfolio, it is free to see what I'm doing in my portfolio. And again, in this video, we will cover the $1,405 I added, any options that I was in, any dividends that are paid out. Again, this is a weekly update, so tune back in, make sure the notification bell is rung. But before we get into that, if you would like to help me out, hit that thumbs up button down below if you find any value in this content. If you're a dividend growth investor, subscribe to the channel. Make sure that subscribe button is clicked. Join us on this journey to financial freedom. Join the Vested Interest community. Again, hit that notification bell so you're notified whenever we put out any new content. I do these portfolio updates every Sunday morning. I also do a stock pick of the day series Monday through Thursday where we look at a stock that's pulled back on the day to see if it's presenting any value. I do subscriber requests there as well. So if you have a company you'd like me to cover in that, go ahead and put it in the comment section down below and make sure that notification bell is rung so you're notified whenever we put out that video. And I also do a monthly recap of the previous month or the month I'm going into, what stocks I'm looking to buy. I just put out a video for stocks I'm going to buy in June, so make sure you look at that one as well. And again, thank you to everyone who's taken the time to do that. Now let's jump back into the video and take a look at this week's update. So no options. I did throw out several options this week. I've been running some options on BABA. I threw out one for J&J again. None of those hit, so no options to report this week. We'll give her a try next week and see how it goes. Dividends. We did receive some dividends from actually our newest addition to the portfolio, Starbucks. We added this maybe a month and a half, 2 months ago. So we finally got some dividends on it. Now, when I say finally, I guess it's the first dividends we would have gotten from when we bought it. But Starbucks Corporation, ticker SBUX, out of the consumer discretionary sector, paid us $22.80 in dividends. Those dividends went right back in. We do have the DRIP set, so dividend reinvestment plan is what DRIP stands for. That just means anytime a company in the portfolio pays out dividends, those funds, in this case the $22.80, go right back in and buy more shares of the same company. So we picked up 0.28789 shares with that $22.80, and those 0.28789 shares added an additional 65 cents. And I know it's not much, but we're continuing to build out this position, so it'll be much higher next time. And I'll take every penny that I can get. And you're kind of seeing the dividend snowball into effect right here. So I added $1,405 and some change, I believe is what it was. Dividends were paid out. Those dividends picked up more shares. Those additional shares added additional income. So that's that dividend snowball in effect right there. And we started adding our new capital on May 29th. We added $1,045.77. And with those funds, we picked up 2 shares of Enterprise Product Partners, ticker EPD, at $27.92 per share. This position I'm not looking to add a lot to, but I would like to nibble on it a little bit, maybe add 2, 4, 6 shares here and there over the next several months. A very high yielder in the energy sector here. It is above my cost basis, but I'm up significantly and my cost basis is so low that I'm willing to add here even though it is above my cost basis. Now I'd love a pullback and then I may dump a little bit more in, but while it's above my cost basis, I'll at least nibble because again, I'm still seeing some value here right now in the energy sector overall in this position as well. 4 more shares of CVS Health Corporation, big pullback in CVS. I'm going to continue to add while it's pulled back. And CVS is out of the healthcare sector. We picked up those 4 shares at $53.43. This one is well below my cost basis. So again, I'm going to try to run this to about 200 shares. I think I'm at 184 or 186 now. We'll see that here towards the end whenever we do the overall portfolio update. But while it's significantly under my cost basis, more than 10% down in my cost basis, I'm going to continue to add here. Realty Income, another one that's down quite a bit below my cost basis. So I want to bring my cost basis down, bring up my dividend yield. Very nice dividend yield on both of these, CVS and Realty Income. Realty Income, ticker O, the monthly paying REIT out of the real estate sector. We picked up those 4 shares at $51.06 per share. Here's that Starbucks position again. So not only did we get some dividends, we're continuing to build it out. So Starbucks, ticker SBUX, we added 6 more shares at $77.27. I think by the end of the week, this was actually a little over $80. So hopefully it stays down in the 70s while I build it out. I am willing to pay to the mid 80s, and I'd like to get this one to 100 shares as well. And it finally dropped below my cost basis, so we added a little bit more to our Haverty Furniture Company's position, ticker HVT, 4 more shares at $27.10. The $1,045.77 we added, all the new shares picked up, added an additional $45.89 in passive income over the next calendar year. And we weren't done. We went back in on May 30th here, right before the end of the month. The 31st was Friday, so this would have been Thursday. We added an additional $359.95. With those funds, we picked up 2 shares of Vale, ticker VALE, out of the material sector. This is a mining company here at $12.17. This is one I'd like to continue to build out as well. It's well below my cost basis. My cost basis is in the low 13s. We'll see that here in a little bit. So while it's pulled back down to the $12 range, I'd like to continue to add to this position. We added 1 share to our Schwab Dividend Growth ETF, ticker SCHD, at $77.11. And 1 share of our Vanguard Total Stock Market ETF, ticker VTI, at $258.51. And these 2 ETFs, I'm going to be picking up at least 1 share per week. Right now, they are near their 52-week highs. If they were to pull back significantly, I would look to the overall market even. If it was to pull back significantly, I would look to add more into these 2 positions. And these ETFs, I'd like to continue to build out well into the future. So these will be a mainstay here on the channel for some time, I'm assuming. With the $359.95 added, the additional shares, it added an additional $10.13 in a passive income over the next calendar year. Total invested $1,405.72. Total passive income added with the dividends paid from Starbucks as well as the new capital and positions bought with that new capital, $56.67 in total. So love to see the passive income continue to grow week after week, month after month, quarter after quarter, year after year. I look at it as I just got a $56.67 raise over the next calendar year. So I'll take it again. And if I can do this every week or even better than this every week, by the end of the year, it will be a significant amount in my annual income. Quick run through the portfolio update sector weights here. We're looking at communications makes up 10.02% of the portfolio. Consumer discretionary at 6.18. Consumer staples 9.6. Energy sitting at 5.81. Financial sitting at 6.03. Healthcare makes up the largest chunk of the pie here at 13.84. Industrials at 6.64. Technology at 7.06. Materials makes up 10.67. Utilities at 10.26. REITs and real estate at 10.99, and ETFs still this smallest sliver here at 2.91% of the portfolio, though it is starting to be built out a little bit here. I imagine eventually this will be one of the larger positions in the portfolio, but for now, it is still the smallest sliver. Over here on the right, you can see the portfolio sector weights broken up exactly the same way by sector. Here are the percentages broken up, same as the pie here, but then you also have the dollar amount allocated to each sector as well, total at the bottom. And here it is, the full portfolio. I know a lot of you come here every week to check out the update on the portfolio, and I'm going to continue to show the portfolio updates every week. I want people to see transparently a real portfolio built out over time, the ups and downs associated with it, what positions in the portfolio look like over time, how I'm building it out, different sectors I'm building out, the diversification I'm building into the portfolio, just to give some people out there who may be on the fence about investing, thinking it's too hard for them to do, give them some confidence and an example of a, again, real portfolio built out over time by someone who's just a regular guy who goes to work every day. I have a wife and 2 kids, so I didn't go to college for finances. I don't have a trust fund. My parents aren't wealthy. As a matter of fact, neither one of my parents even graduated high school. I graduated college, but not for finance. So if I can do it, and if I can find the time to do it, you can do it as well. Now, you don't have to do it the same way I'm doing. You don't have to go in here and pick, 30 plus different companies that you're interested in and do the research on them and then keep up with them. If ETF investing is the easier way to go, you want to just set it and forget it. VOO, S&P 500, the VOO ETF, the S&P 500 or SPY ETF are what Warren Buffett would recommend. I believe both of those are in his overall Berkshire Hathaway portfolio as well. So if you want an easy way to do it, just go ahead and go with the S&P 500 ETF, dump money in it every week or every month or whatever your timeline is, and consistently invest into that. You don't have to follow and do single individual stocks. I like the individual stocks. It's become a hobby of mine. I'm interested in a lot of these companies because I use them. Ally Bank is my bank, so I know Ally Bank. Bank of America was the first bank I opened an account with, so that's why I have them in there. Comcast, everyone's well aware of Comcast. Cisco, a lot of the computers that I've used in the past, and even our IT infrastructure uses Cisco systems. CVS, I shop at CVS. That's where we get our prescription drugs. Enbridge is an energy company, just across the lake from me here in Michigan, so I'm well aware of Enbridge. There's a big deal here over the last several years about the pipeline they have going under one of the Great Lakes into Michigan. So they're in the news every now and again. EPD is a company down in Texas I was familiar with. I lived down in Texas for several years. My mother's from down there. I helped build the Dallas County Detention Center down there and Hector Garcia Middle School, for any of you that are interested in or know Texas. My grandfather lived down near Waco. I lived down in Ennis, Texas, and Dallas, Texas. HPQ, my computer for my work is a HPQ computer. HVT, Haverty Furniture, is a business in Michigan, furniture company in Michigan that I'm very familiar with. I bought some furniture with. J&J, who doesn't know J&J? Kraft Heinz, same things. If you've eaten any hamburgers or hot dogs, you probably have put Kraft Heinz ketchup or mustard on it. Kroger, I shop at Kroger. So you get the idea. I won't go through them all. I'm well aware of these companies because I use them. And if I'm using them, Starbucks, my wife, gets her tea from Starbucks. And if I use them, why do I not want to invest in them, especially if they're good companies with growing cash flow, high returns on their invested capital, and returning to me dividends every quarter, and in Realty Income's case, every month. So that is the reason I look at a lot of these companies. I'm not only familiar with them, but a lot of them are companies that I actually use. So I benefit from it. Every time I buy a product, I look at it as I'm supporting myself, and I'm getting a little bit of those funds that I just spent back in the dividend whenever the dividends are paid out. But anyways, as you can see here in this column, you've got the tickers, total shares of each position, current price as of the close of business on Friday, the market value as of the close of business on Friday, average cost per share, that's my average cost per share here, my purchase price, how much I have into each position, the total return, whether I'm up or down. Again, I'm going to transparently show whether I'm up or down, right? So that you can see what a real portfolio and the volatility of a real portfolio looks like over time. You're going to go up, you're going to go down. That's just the nature of stocks. Warren Buffett famously said, if you can't handle a 50% loss in your cost per share, you shouldn't be investing in individual stocks, because it will happen from time to time. Again, percent return up or down, you can see here the red, that means I'm down. When I see the red, I look at it as if these companies are still good companies, they still meet the criteria that I set up when I invested in them. My thesis for investing in them hasn't changed. They aren't in financial trouble or going bankrupt or something like that, or having trouble with revenue or something like that. When I see the red, that's like walking into a store and seeing a sale. I don't run out of the store and go, I'm not buying anything. Oh my, it's cheaper today. Why is it cheaper? No, I look at it as a buying opportunity, and a lot of times I might buy more of whatever it was I was going to purchase if it's on sale. That's the idea behind a sale. Excuse me. Man, I'm sorry. My sinuses are just kicking my butt this month. What sector each company falls in, whether they're a quarterly, monthly, semi-annual payer. Current dividend yield, again, as of the close of business on Friday. My yield on cost here, portfolio weighting. So what we saw on the previous slide was each sector weighting. Here's each portfolio, each position's portfolio weighting. And just a quick note on that. For the weightings, I don't like any one sector to be more than 20 to 25% of the portfolio. I don't like any one position to be more than 10%. So if a position starts to get over 10%, I'll back off. It doesn't mean I'm going to sell it or trim it or whatever. It just means that I won't add to that position. I need to look to add elsewhere. Even if it's pulled back, I'll just back off adding to it if it gets over 10%. Now, if it's run up significantly, let's say a position has run up significantly. Let me look at for one here. Owens Corning, for example. I'm up 96.07%. Really wish I'd have dumped more into Owens Corning whenever it was down. I only got to 44 shares before it really started running up, but that's just the way it is. So if Owens Corning, let's say I added another 100% and all of a sudden it's only 3%, so it's not like it's going to get to 10% anyway. But if it did happen to get to 10%, let's say it ran up another 96%, got to 180%. I might trim a position like that is up so much that that's the reason it's over 10%. Because then if it pulled back or when it pulled back again, I could look to add a little bit more cheaper. So there is going to be times where I maybe trim a position that's run up a lot that is over 10%. But for the most part, just because a position runs up over 10% doesn't mean I'm going to trim it or sell out of it. It just means that I'm not going to add there. Estimated annual income from each position here, payout months, dividend growth year over year, and where it sits at 15% of its 52-week low. I use this 15% of its 52-week low as a high benchmark of what I'm willing to let my average cost per share run to. For example, BABA, I can run up to $76.62. My current cost basis is $75.44. It's over my cost basis. So I could continue to add to BABA here so long as my $75.44 didn't get higher than $76.62. So I wouldn't be able to add a lot, but while it's close here, $78, $80 per share, I might nibble a little bit. If it dropped down below my cost basis, obviously I could add. But this number here, where it sits at 15% of its 52-week low, just gives me a high watermark of what I want my average cost per share to be. I want to be under this number. So total shares, 6,687.113. Current portfolio value, $259,679.09. I have $245,402.02 into the portfolio. I am up $14,277.07 or up 5.82%. I do not focus on these numbers. This is not what I'm really focused on. Current dividend yield, 4.276%. My yield on cost, 4.525%. And that's why it's circled in red. This is what I focus on. The dividend income provided by all the positions in the portfolio, the annual income I get from this portfolio currently sits at $11,105.07, and it continues to grow week after week, month after month, quarter after quarter, year after year, whether the market's up, whether the market's down, whether the market's floating sideways. As I add new capital, like the $1,405 I added this week, as the positions in the portfolio pay out dividends, and those dividends buy new shares, like we saw with Starbucks this week, and as positions in the portfolio increase their dividends. That's what these highlighted in yellow over here is, quarterly, monthly, semi-annual. These are the positions in the portfolio that have already raised their dividends this year, right? And that's what we're looking for. We're looking for these, that's why we call it dividend growth investing. We're looking for these companies to continue to raise those dividends year over year so that our growth is not only from capital appreciation, like American Water Works here, we're up 9%. So it's nice to see that capital appreciation, but I'm happier to see the dividend growth over here at around 8%, because that means my income is going to be growing by 8%, even if this was to stay flat. Let's say we were at 9% growth for the next, and the price didn't change for the next 3 years. So long as it continued to grow this dividend at 8%, my income from this position is going to go up by 8% a year. So this is what I'm focused on. The estimated annual income, again, $11,105.07, getting very, very close to $1,000 a month here. I think by not the end of June, but the end of July, we will be very close to over $12,000 in estimated annual income, or over $1,000 a month in dividends. And the dividend growth right now, overall, the portfolio at 5.84% a year. So there it is, folks. Let me know what you think down in the comment section below. Do we have any positions that are the same? Are you investing in any of the companies that I'm investing in? If not, let me know what you're buying. What are you buying in the month of June? What dividends were you paid out this week? What are you watching? What's on your watch list? What hasn't pulled back quite to your buy range? Let me know down in the comment section below. And as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Hit that subscribe button. Join us on this journey to financial freedom. Join the vested interest community. Drop a comment down below. Let me know what you think of the video. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great weekend, and we'll see you in the next one. I'm not a financial advisor. You can read the rest of this. You know I'm not a financial advisor. Please don't blindly copy someone on YouTube. Do your own due diligence. Make sure you're doing your own research. We're not financial advisors. I'm not your financial advisor. Even if I was a financial advisor, I'm not your financial advisor. I'm my financial advisor. So make sure you're doing your own due diligence. You can read through the rest of this, but this is the disclaimer here.